Bonds are usually considered safer than stocks, but what about over the long term? Might they actually be riskier? That's what we're going to talk about in this episode of the LawyerFI Podcast.
This is the LawyerFI Podcast, equipping lawyers and other high-income professionals to reach financial independence. Adam B. Cordover is a Florida-based collaborative family law attorney. He is not a financial advisor, accountant, or tax attorney. This podcast does not provide legal, financial, or tax advice, and is for information and entertainment purposes only.
Welcome to the LawyerFI Podcast, where we explore how lawyers and other high-income professionals can take control of their money, invest with confidence, and design a life of purpose beyond the billable hour. I'm your host, Adam B. Cordover, and today we're going to tackle one of the most misunderstood areas in all of investing, bonds. Now, I know you didn't become a lawyer to think about fixed income investing. And if you're anything like I was, bonds may seem boring, overly technical, or just something you'll worry about later. But understanding how bonds work and where they fit in your investment plan is absolutely essential to reaching financial independence. Today we're going to talk about total bond market index funds and why bonds have a reputation of being safer than stocks, at least in the short term. These bond funds are the ones that experts like Rick Ferry and J.L. Collins often recommend for broad bond exposure. But we're also going to go one level deeper because the truth is, safety isn't always what it seems. Over short and medium periods, bonds, especially those backed by the U.S. government, really do offer stability. They don't tend to crash as severely as stocks do. They can serve as a buffer when markets are chaotic. But over the long term, there's another lurking threat, inflation. And it's a threat that bonds are particularly vulnerable to. Stocks are far more volatile in the short run, but they've historically crushed inflation over long periods. So which one is really safer? That's one of the most important investment questions you'll ever have to answer, and there's no one-size-fits-all approach. As Paul Merriman often says, your allocation between stocks and bonds may be the single biggest decision you make in investing. So in this episode, we're going to explore both sides of the story, why bonds are considered safe, and why over decades they carry their own risk. We'll look at different fund options, historical risks, and how to think about your bond allocation based on time horizon, risk tolerance, and goals. Now let's get started. If you ask most people why they invest in bonds, you'll usually hear one word: safety. Bonds, especially government bonds, have long been considered the safer side of an investment portfolio. And when it comes to short-term and medium-term volatility, that reputation is well earned. And let's start with U.S. Treasury bonds. These are backed by the full faith and credit of the U.S. government, which makes them arguably the safest fixed income investment in the world in terms of credit risk. When you buy a treasury bond, you're lending money to the federal government in exchange for interest payments and the promise of getting your money back at maturity. That makes treasuries especially attractive during uncertain times. But you don't need to go out and find and buy individual bonds. You can use bond funds, and the most popular type is the Total Bond Market Index Fund. We'll get into what's inside these funds later in the episode, but for now, just know they typically include government bonds, mortgage-backed securities, and high-quality corporate bonds. It's a simple way to diversify without having to be a bond expert. What makes bonds appealing in the short term is that they rarely crash the way stocks do. Take 2008. Stocks lost more than 50% of their value from peak before bottoming out. The U.S. bond market? It actually went up that year. During the COVID crash of early 2020, stocks dropped 34% in a matter of weeks. Bonds? Down about 1%, with some areas even in the green. That stability is why people often move into bonds as they get closer to retirement or big financial goals. And it's not just about what happens on a chart. It's about what happens in your brain. If you've never lived through a serious market crash, you might think you're comfortable with risk. But when your portfolio drops 30 or 40% and it's your actual money, your gut may say otherwise. This is where bonds can make all the difference. Let's say you hold 40% of your portfolio in bonds. If stocks fall by 30%, your total portfolio might only drop by around 18%. Now that's still painful, but it's often enough to keep you from panic selling. Now imagine you're 90% in stocks. That same crash feels much worse. And the real danger is not the crash itself, it's reacting to it. Selling low, waiting too long, and then buying back in at higher prices. That's the trap many investors fall into. They can't tolerate staying invested during the downturn, even though history tells us that panic selling is one of the worst things you can do for your investments. Bonds generally offer that stability that can make it a bit easier to prevent yourself from selling. So how do you know your risk tolerance? Well, here's a quick test. If you find yourself checking CNBC or Fox Business every day when markets are turbulent, refreshing your brokerage app, losing sleep over market headlines, that's a clue you may want more bonds in your portfolio. On the other hand, if you can go weeks or even months without checking your balance or stressing about swings, you probably have a higher risk tolerance and may be comfortable with fewer bonds. Understanding your own emotions and behavior is just as important as understanding your portfolio. Because at the end of the day, the right investment plan isn't just the one with the best numbers. It's the one you can stick with. And to bring this all together, I want to credit J.L. Collins, author of The Simple Path to Wealth, for one of the best metaphors on bonds. He compares them to the ballast in a ship. They won't make you sail faster, but they'll help keep you upright when the waves get rough. It's a powerful image, and one worth remembering the next time the stock market throws a tantrum. So we've talked about how bonds can be a stabilizing force in your portfolio, especially in the short and medium term. They cushion the blow when stocks take a dive and generally give your portfolio that steady, dependable foundation. But now let's zoom out and talk about the long view, because over the course of decades, bonds carry a very different kind of risk. Not market volatility, but something much sneakier: inflation. Inflation is the slow erosion of your purchasing power over time. A dollar today won't buy you what it did 10 or 20 years ago. And the longer your investment horizon, the more damage inflation can do. This is where stocks have historically had the upper hand. While bonds tend to generate steady, predictable returns, they don't always keep up with rising costs. In fact, when inflation is high, bond investors can lose real value, even if their account balances stay the same or inch up. That's because most traditional bonds pay a fixed interest rate. If inflation rises faster than that rate, you're effectively losing money. Stocks, on the other hand, represent ownership in real businesses, companies that can raise prices, grow earnings, and adapt to changing economic environments. Over long periods of time, that growth has not only kept up with inflation, but significantly outpaced it. Historically, and as referenced in Stocks for the Long Run by Jeremy Siegel, the U.S. stock market has returned about 7% annually after inflation, while bonds have returned closer to around 2%. That doesn't mean bonds are bad, they just serve a different purpose. But it does mean that if your portfolio is too heavily weighted in bonds, especially early in your investing career, it may take you much longer to reach financial independence. By the way, we talked about calculating your financial independence number in the first episode, and you'll find a link to that in the show notes. So it's a trade-off. With bonds, you're getting stability, but giving up some growth. With stocks, you're accepting volatility in exchange for higher expected returns. Your job as an investor is to find the mix that makes sense for you, based on your goals, your timeline, and your risk tolerance. We'll look at how to make that decision in just a bit, but first, let's talk about the Total Bond Index Fund and provide some specific ticker symbols so you can do your own research. So when we talk about total bond market index funds, what are we really talking about? These are broad funds designed to give you exposure to high-quality investments through nearly the entire U.S. bond market in one simple package. That means government bonds, mortgage-backed securities, and high-quality corporate bonds, all rolled into a single fund. Total bond funds tend to stay away from so-called junk bonds, which may provide higher returns but are riskier. And if you're going to take risk, well, That's what stocks are for, and shouldn't be the purpose of bonds in your portfolio. Let me give you a few examples of total bond funds so you can look them up easily on your own. Vanguard's Total Bond Market Index Fund has the ticker VBTLX. Its ETF version is BND. Fidelity offers FXNAX, and Charles Schwab has SWAGX. These funds are broadly diversified and easy to access, and they're pretty darn cheap. Here are their expense ratios. Vanguard's VBTLX is at 0.04% and BND is at 0.03%. Fidelity's FXNAX is at 0.025% and Schwab's SWAGX comes in at 0.04%. To put that in perspective, that means that a 0.04% expense ratio on $10,000 is just $4 a year. So what are the risks? Even though these funds are diversified, they can carry interest rate risk. That means that when interest rates rise, the value of existing bonds tend to fall. So if you're going to hold a bond fund and rates go up, your fund's price may drop. There's also inflation risk, as we discussed earlier. And while these funds include a mix of government and corporate debt, they still don't offer the kind of upside potential that stocks do. Their job is to stabilize, not drive growth. But for many investors, that's exactly what they're looking for: a ballast, a smoother ride, less emotional whiplash, a reason to stay the course when everything else is shaking. So when should you start seriously considering bonds in your portfolio? Well, I'll tell you what I'm doing, but with a clear disclaimer. I am not recommending this for anybody else. It's just what works for me. Right now, I have about 5% of my portfolio in bonds. Now that's considered extremely aggressive, but I'm comfortable with that because I've got a long time horizon. I plan to keep working and investing for many years to come, and as I get older, I plan to slowly increase that bond allocation. My goal is to bump it up from 5% to 10% at age 50, and then another 5% every 5 years, capping out at around 25%. So that's my plan, and your plan may, and probably should, look very different. For comparison, let's take a look at Vanguard's target retirement funds. These are designed for people retiring at a specific date. Their target retirement income fund, designed for somebody already in retirement, holds about 70% in bonds and just 30% in stocks. Now that's a pretty conservative allocation, but it could make sense for people who are withdrawing money and want to reduce volatility and no longer are earning an income. Here are a couple of other points of comparison from two great figures in the financial independence movement. Paul Merriman of the Merriman Financial Education Foundation last year wrote that at age 78, he and his wife had a 50-50 stock bond allocation. J.L. Collins, on the other hand, who is in his late 60s, has allocated 75% of his portfolio in stocks, while 25% is in bonds. You can find links to these two authors discussing the reasons for their personal allocations in the show notes. So where you fall on that spectrum depends on your age, your goals, and especially your risk tolerance. If you're young, saving aggressively, and have decades before you need the money, it may make sense to lean more heavily into stocks. But if you're approaching retirement, saving for a short-term goal, or just someone who really values peace of mind, a heavier bond allocation makes perfect sense. There's no perfect formula, but if you're honest with yourself about how you react to market swings, and you know your timeline, you'll be much better equipped to build a portfolio that works for you. Let's bring it all together. Bonds may seem boring, but understanding how they work and where they belong in your portfolio is one of the most important steps towards financial independence. They can reduce volatility in the short and medium term, offer emotional stability when markets get choppy, and serve as a flexible tool as your goals evolve over time. But remember, what feels safe today may not always be safe over the long haul. That's why it's so important to balance your timeline, your temperament, and your long-term plan for inflation and growth. Whether you're 100% in stocks or have the majority of your portfolio in bonds, the key is to build a portfolio that you can actually stick with through the ups, the downs, and everything in between. So what is your stock bond allocation in your portfolio? I invite you to let us know in the comments, and I'd love to hear why you have chosen your allocation. Further, if you found this episode helpful, please like, subscribe, and let others know. So thank you so much for joining me today, and please remember, financial independence isn't just a dream. Now let's go achieve it. This episode of the LawyerFI Podcast is sponsored by Family Diplomacy, a collaborative law firm. If you are in Florida facing divorce and you are looking for a private process customized for your family needs, ask us about the collaborative divorce option. You can give us a call at 813-443-0615 or visit us at familydiplomacy.com. We've got offices in Tampa, St. Petersburg, and Sarasota by appointment, and we accept clients throughout the state of Florida. You are not alone. We can help.
This has been the LawyerFI Podcast. Visit our website and learn more at LawyerFI.com, including information about how to become a sponsor. Watch or listen to us on YouTube, Apple Podcasts, Spotify, and anywhere you get your podcasts from. You can also reach us on Facebook, Instagram, TikTok, and LinkedIn. LawyerFI is hosted by Adam B. Cordover and produced by Eric Sachs. Original music is by Jake Biller. Adam B. Cordover is a Florida-based collaborative family law attorney. He is not a financial advisor, accountant, or tax attorney. This podcast does not provide legal, financial, or tax advice, and is for information and entertainment purposes only.